renting or buying? Which is the correct decision for you and your family? In today's video, I'm going to run you through a quick example of what numbers you should include when comparing the two, and then I'm going to equip you with some easy to understand formulas that will help you easily calculate whether buying or renting is right for you. To begin, we need to start by calculating all costs of each choice. For buying, key expenses include down payment and closing costs. In Canada, you need at least 5% down and 10% for the portion above $500,000, plus the fees that are incurred when buying a home. If you were buying a home worth $500,000, your minimum down payment would be $25,000 and closing costs would likely be around $5,000. To calculate monthly mortgage payments, use a mortgage calculator to find your principal and interest payment. For example, at a 5-year fixed rate of 4.29% on a 25-year amortization, if you had a mortgage balance of $494,000, that's assuming you used a 5% down payment on a $500,000 house, your monthly payment is roughly $2,676 per month. Property taxes, condo fees, and insurance, these can easily add up to hundreds of dollars more per month, but will be property specific. In our case, let's assume $5,000 in property taxes and $1,500 for home insurance. The property itself is not a townhouse or condo, so no condo or HOA fees. For maintenance and repairs, this is an important one. Make sure you put away funds to maintain the home. A rough estimate is 0.5% to 1% of the home's value per year. Let's meet in the middle and budget for 0.75%. In our case, this is $3,750 per year. This gives us a total monthly cost to operate our home of $3,532.28. For renting, expenses are much simpler. Security deposit and the monthly rent. You can count on your security deposit to being usually 1 month's rent. Finding our monthly rent payment. The easiest way is to check local averages for a similar home. In our case, to rent out a property that's worth $500,000, in my market, it would be in the range of $3,000. One extra cost when renting, it's usually much cheaper than homeowner's insurance, is renter's insurance. In this case, let's say $50 a month. Now let's compare the monthly cash flow, what you'd pay each month to own versus rent. With our numbers above, the buyer pays $3,532 versus a renter's $3,075. That's a gap of around $457 per month, plus you still have most of your $30,000 as the deposit was much lower. Now, which is better? The answer hinges on assumptions like home appreciation and investment return, which can vary greatly. So I'm going to help you with the first simple to understand formula. It's called the 5% rule. If your annual rent is under about 5% of the home price, then renting and investing the savings might match or beat buying. Or a $500,000 home at 5% is $25,000 per year, or roughly $2,083 per month. In our example, the rent is $3,000. It's way above that threshold, suggesting that buying edges out our renting, assuming moderate home price growth. In either case, this rule assumes disciplined investing of all savings or steady appreciation and no surprises. Factors we'll discuss below. Another way to compare is the price to rent ratio, home price divided by annual rent. A lower ratio favors buying, a higher one favors renting. For example, a ratio below 15 usually signals buying is good value, while above 20 means renting may be cheaper. In many Canadian cities today, ratios are above 20, meaning the typical condo costs 20 plus years of current rent. A warning that renting might be more cost effective in the short term. In our example, a home that can be purchased for $500,000 or rented for $36,000 annually would have a ratio of 13.9, meaning it's a good value to buy at. In practice, do your own math or use a reputable calculator by following these steps. Estimate your own costs. Use a mortgage calculator. You can use one from CMHC or an online one. With your down payment, rate, and amortization, you're going to add your taxes, insurance, condo fees, or maintenance. You'll then estimate renting costs. Find a realistic rent for a comparable property. Include renter's insurance if needed. Compare the difference. If the buyer's monthly cost is much higher than the rent, you'd have extra cash by renting. Ask yourself, can you invest that extra cash? Then factor in home equity. Remember that mortgage payments build equity. You save part of the payment, whereas rent does not. Try calculating your net worth after, say, 5 or 10 years under each scenario. This calculation would include the house price with the growth rate versus invested returns of your rent. Financial calculators and worksheets can be helpful, but it's critical to be realistic about rates and returns. One analysis finds renting only beats buying under optimistic assumptions. The example is 6% after tax stock returns and rent never rising. If investments underperform or if your rent keeps going up, owning often wins out in the long run. Okay, for this next section, let's take a look at some non-financial factors. Stability versus flexibility. Beyond dollars, there are personal factors to weigh. Here are the key pros and cons of buying versus renting. Home ownership pros. You get stable housing costs with a fixed rate mortgage. Your principal and interest payment is locked in. Even if prices, inflation rise, that means that your housing payment stays the same year after year, at least for the term that you set, giving inflation protection. In contrast, renters can face rent increases. Building equity. Every mortgage payment pays down principal, so you own more of the asset over time. This equity is a forced savings, which you can then leverage. Over decades, home prices tend to rise, further growing equity. Freedom to customize. If you own the place, you can paint, renovate, have pets, or a garden without landlord approval. Tax incentives and pride. In Canada, there's no annual tax break for mortgage interest, but you do avoid capital gains on your principal residence when you sell. Many owners also feel a sense of community and pride in being a homeowner. Now let's take a look at the home ownership cons. High upfront costs and less flexibility. You need a big down payment and closing costs. Selling a home also takes time and money. If you need to move quickly, selling could be difficult. Maintenance and unexpected costs. The roof, furnace, plumbing, and exterior are all your responsibility and can cost thousands. Market risk. If house prices fall, your equity can shrink and even go negative if you owe more than the home is worth. Interest rates can reset and property taxes can rise. Now let's look at the pros of renting. Flexibility. It's so much easier to move anywhere at lease end. Good if your job is uncertain or you'd like to try different places. You avoid any risk of home values dropping. Predictable short-term budget. No large down payment or maintenance costs. Generally, lower starting costs as well. You share no responsibility for repairs or taxes. Landlords cover the major repairs and pay your property taxes. Renting cons. No equity building. Every dollar that you pay in rent is gone. It doesn't come back to you. You must be disciplined to invest the difference yourself, which can be hard. Rents can rise. With inflation or housing shortages, landlords may hike rent when leases renew. You have no control over that increase, unlike a fixed mortgage payment. Less stability. The landlord could sell or change terms. You have fewer rights to alter the space. As we mentioned, no paints, no pets, things of that nature. In short, buying locks in housing costs and builds wealth over time, but is illiquid and comes with risks and upkeep. Renting offers flexibility, simpler budget, but you forego long-term equity and shelter from inflation. Let's consider inflation specifically. Owning at a fixed rate can be a hedge. When you buy a home with a fixed rate mortgage, you will have a predictable monthly payment for the life of the loan, meaning inflation won't raise that cost. Meanwhile, if you rent, your rent can be raised with inflation. That's why homeownership can be more stable. It lets you repay a fixed debt with devalued dollars later. But remember, the flip side, high mortgage rates like we saw a couple of years ago make owning very expensive, whereas rents, if lower, might be comparatively easier in the short term. How should you decide? Tools and steps like step 1, list your numbers, gather your expected figures, target home prices, down payment, mortgage rate, compare fixed versus variable, get your amortization, and use your income and other debts to check affordability. Then list comparable rent prices in your area. Step 2, run the calculators. Use CMHC's mortgage calculator or any banks to see the monthly payment. Don't forget to include property taxes, condo fees, insurance, and an estimate for maintenance. For renting, account for rent increases, maybe 2 to 3% per year, and the cost of moving when the lease ends. Step 3, compare scenarios. There are affordable online rent versus buy calculators, but you can also do a simple analysis. Imagine 5 or 10 years in the horizon. What will your net worth be in each case? If buying at the end of 10 years, you'll have paid off some mortgage and hopefully have a higher home value. If renting, you've kept your down payment, invested elsewhere, and the monthly savings invested. Calculate how much that nest egg could be worth. For instance, saving $1,000 a month at 5% yield grows very rapidly. Step 4, use simple rules. In addition to calculators, remember simple checks. If the annual rent is well above 5% of the purchase price, buying is usually better. If it's below 5%, renting might come out ahead. Consider the price to rent ratio. Price divided by the annual rent. If that number is above 20, it usually means renting is cheaper, at least on paper. Think about stability versus flexibility. If you plan to move in the next 2 to 3 years, renting likely wins, as you wouldn't recoup buying costs. And if you plan to stay 7+ years, buying often pays off. Step 5, account for the intangibles. If the number crunch is close, think about personal priorities. Do you value flexibility, travel, career moves, or do you crave stability and the forced savings of owning? Do you handle the risks well? These can tip the decision once finances are nearly even. In conclusion, ultimately both owning and renting can be correct decisions depending on your situation. The key is to do a clear comparison. Calculate your actual costs and savings in each scenario and weigh the lifestyle factors. In summary, if you plan to stay long-term and can afford the down payment and monthly costs, buying often pays off. You lock in payments and build equity. If you expect to move soon or want flexibility, and if renting is significantly cheaper, then renting may be better. And with that, good luck with your home search or rental search. If you enjoyed this video, I'm positive you'll like this one as well.